Well, it's now going to be even more expensive for Americans to borrow money.
Federal Reserve raised its key interest rate by half a point today in the fight against inflation. Now, this brings the rate to its highest level in 15 years. It's also the 7th rate hike this year. The Fed also signaled more increases are ahead, and it will remain through the next year. And there is concern the raise could cause a recession. Today's hike follows a new government report which shows inflation continues to ease.
Joining us now to explain how today's increase will impact all of us is Craig Bolanos, the founding partner and CEO of Wealth Management Group. Thanks for being with us.
Oh, no, great to be back. Exciting news for savers. Terrible news for those who have borrowed money. A lot to unpack here today.
Well, you say exciting news for savers, but I always laugh when I get the 9-cent interest credit from my bank.
I don't laugh.
Yeah,
he laughs.
That's true. I always ask, what's the point?
And Micah, no, you shouldn't laugh over it, but those days are gone. I mean, best you know. If you're looking in the right spots now, we have 3% money markets, 3.5% to 3.75% CDs, and many people can and probably should return to looking at U.S. savings bonds because people can still get Series I savings bonds at 6.8%. There is good news out there, a small silver lining going into the holidays.
But Craig, we have the greatest economy right now than any of the other countries going on, and they say that unemployment is low. Why do we need to keep doing this?
You know, it's tough. At the end of the day, here's what we know. The enemy for everybody, for workers, for consumers, is inflation. And we need to do some form of interest rate hikes to take some of the momentum out of the economy. It's disappointing to hear. As you mentioned, we've got low unemployment. Last time I checked in my neighborhood, it seems like everybody is spending for the holidays. We're happy. Why does the Fed want to rain on our parade? Simple. We learned our lesson back in the late 70s and early 80s. If you don't quell inflation, it leads to a whole host of other issues, and that's what the Fed is trying to do very assertively from this last meeting.
So how close are we to the inflation situation stabilizing to the point that we're no longer looking at these rate increases?
Well, you know, I think we're not there yet. I mean, my gas tank feels better. Certain things at the food store feel better. But the reality is we all learned, while I celebrate that inflation has declined, not 1 month, but now 2 months in a row, year over year, I'm celebrating 7% price increases. That's not too much to celebrate. But I think the real question is, when will the Federal Reserve get to a point that they say we don't need to raise the cost to borrow anymore? And it's clear that it wasn't ending today. They're going to need to continue to raise rates at a much slower, more gradual pace in 2023 until we get the parts of this inflation that are not yet coming down. That's rent, that's healthcare, and that's services. So sometime mid next year.
Now, they say they're kind of doing it in installments, you know, a quarter more maybe in February. But let me ask you this. How's it affecting Wall Street right now?
Well, I mean, Wall Street was not happy today. Wall Street would have been thrilled and doing cartwheels had they said, hey, guys, we're done. We're going to go ahead and pause. But in the same vein, Wall Street's not upset because we've had two back-to-back months of decreasing inflation. We have a Federal Reserve who's going to moderately continue to raise rates. And best of all, Wall Street is recognizing that the economy hasn't gone off the rails. The consumer has remained strong. The jobs market has remained incredibly robust.
We're at 50-year lows right now, right?
We're in a great spot at 3.7%, and we all know what's going to happen. At some point in time, everyone's going to wake up with a little bit of a financial hangover. You know, that's because of the outsized consumer shopping we're doing this year. The fact that the home equity line of credit, the student loan, and the credit cards all have a higher rate. Clearly, housing isn't going to be as hot as it once was. And that's probably going to cause us to have a soft patch next spring, next summer. That means a small, mild recession. But remember, not all recessions are like the Great Recession. This too shall pass. So I think Wall Street is torn. Is the glass half full? Is it glass half empty? Time's going to tell, but continue to invest for the long term.
At least we have a glass, right?
Yes, we do. We do.
Thank you, Craig Bolanos. We appreciate it. You can check out Wealth Management Group in Inverness and Downers Grove and online at investwithwmg.com.
Still to come, the Grinch cracked